Well, as we move into the fourth quarter of 2019, the excellent strength in occupational markets has continued to sustain investors' interest in the sector. The pockets of rental growth are continuing to merge and create a much more interesting picture across the whole map of Europe. But there's been an additional driver for interest in the logistics sector, and that's come from the compression in 10-year government bonds. So whilst we may have record low cap rates in the logistics sector, we have record wide spreads over the risk-free rate of borrowing. The attractiveness of bond-like investments, the long-dated, secure income streams that logistics offers, it has been attractive to investors who are looking to lock in that arbitrage between very low cost of debt, it's very accretive to returns. But because of the strength of occupational markets, we see very low vacancy rates, approximately 4% across the board, and that's taking the risk out of short-dated investment. So we're seeing more core plus investors occupying the space that was previously seen as value add. The hotspots for investors are really located around the large cities. Population creates drop density, and that means you can deploy e-commerce models in a very profitable fashion. So the hotspots are around the bigger markets, but the demand for logistics space that comes from e-commerce is not confined to the big cities. It's a generic secular trend, and as a result, we're seeing an uplift across the board.